When we think about stock market legends, our minds usually jump to what? Math whizzes, right? Quants, crunching numbers. But what if I told you one of the all-time greats was a philosopher? Let's dive into the mind of André Kostolany, a guy who argued that true success in the market isn't about calculating, it's about thinking. So this is the man himself, André Kostolany. And you have to understand, where everyone else was staring at spreadsheets, he saw a grand theater of human psychology. This guy was born in Hungary way back in 1906, studied philosophy and art, and even dreamed of becoming a pianist. Finance wasn't his first love, but when he found it, he treated it like an art form, not a science. He called himself a speculator and a bon vivant, basically someone who really knew how to live life to the fullest. And this quote? This is the absolute core of his philosophy. He believed that the stock market isn't some machine you can just reverse engineer with a bunch of formulas. No way. For him, it was more like a canvas, painted with the unpredictable, emotional, and, let's be honest, often totally irrational strokes of human nature. This one idea is the key to understanding everything he had to say about money, markets, and, well, us. So, how are we going to unpack his way of thinking? We'll break it down into 5 parts. First, we'll get to know the man a bit better. Then, we'll jump into why he saw the market as a psychological game. After that, we'll look at the toolkit every speculator needs. Then, his model for booms and busts. And finally, we'll wrap up with his timeless legacy. All right, first up, who was this guy really? I mean, what was the story behind the legend? Because his journey, well, it was anything but typical. So get this, his path really started in the arts. His dad sent him to Paris in 1924, but not to some fancy investment bank. Nope, he was sent to work as an apprentice for a family friend who was a stockbroker. And from that very moment, right up until he passed away in 1999, he was just completely captivated by it all. He ended up becoming one of the most unique and celebrated thinkers in the world of finance. But here's the kicker. What really made him tick? It wasn't just about getting rich. Kostolany said over and over that the real thrill wasn't the cash you made from a good trade. The real pleasure was the intellectual high of having an idea, a thesis about the world, and then watching it be proven right when everyone else thought you were wrong. The money? That was just a nice little bonus, a confirmation that your thinking was on point. And that way of thinking leads us right to his central idea. If the market isn't about math, then what is it? For Kostolany, the answer was simple. It's all about psychology. He came up with this brilliantly simple formula to explain it all. Money plus psychology equals the trend. Think about it. It's just 2 ingredients. First, you've got money. Is there a lot of cash available, ready to be invested? And second, you've got psychology. What's the mood of the crowd? Are people optimistic or terrified? When you've got lots of money and a positive mood, well, the market goes up. When one or both of those turns negative, it goes down. It's that simple, really. It's all about the supply of cash meeting the emotion of the crowd. And he had these great names for the people in the market. He split them into 2 camps. First, you have the shaky ones. You know these people. They're running on pure emotion, wild greed when things are good, and blind panic when they're bad. They jump at every news headline, every tweet. Then you have the hard-boiled ones. These are the thinkers. They have a strategy. They have patience. They act with their head, not their gut. Now, take a guess who comes out on top in the long run. And this is why he'd say you just can't predict the market with 100% certainty. For Kostolany, the market has moods, It can be totally illogical, doing things that make absolutely no rational sense. That's exactly why trying to treat it like a pure science is just destined to fail. You've got to feel its character, not just crunch its numbers. Okay, so if speculation is an art, what tools does the artist need? Well, Kostolany had a very clear list. He called them his 4 Gs, which comes from the German. First is Geld, which just means money. You need capital. And, this is key, it can't be borrowed money. Second is Gedanken, or thoughts. You need your own ideas, your own strategy, and the guts to stick with it. Third is Geduld, patience. This is a big one. It's that rare skill of just sitting through the storms without freaking out. And last, Gluck, or luck. You gotta have a bit of humility and admit that sometimes you just need a little bit of luck. This quote is, well, a bit blunt, but it perfectly sums up that 3rd G, patience. What he really meant was that you make money with your ability to just sit there. It's not about being a genius who's constantly trading in and out. It's about having the endurance, the sheer stubbornness to hold on through all the chaos until your big idea finally pays off. And he was convinced that real wisdom didn't come from a textbook.
It came from getting burned. For Kostolany, failure was the best teacher you could ever have. He believed that if you hadn't gone bankrupt at least a couple of times, you couldn't really call yourself a speculator. It's about losing it all and then having the toughness to figure out why you lost that truly teaches you how the market works.
So, where does all this lead? Well, Kostolany didn't see the market as a line going straight up. He saw it as a cycle, a predictable rhythm of boom and bust that just repeats over and over. And his famous metaphor for this was an egg. The egg of Kostolany. It's just a simple way to visualize that the ups and downs are connected. They're part of one continuous loop. What goes up must come down, and what goes down eventually comes back up. The whole trick is just knowing where you are in that cycle at any given time. He actually broke down both the upswing and the downswing into 3 distinct phases. It always starts with a correction phase, where things are just kind of adjusting. Then you get the accompaniment phase, where the trend really starts to pick up steam. And then comes the final and most dangerous phase, exaggeration. This is where pure psychology takes the wheel. Greed drives prices to insane highs, think the dot-com bubble, or panic sends them crashing way below what they're worth, like in 2008. So what's the secret sauce? It's being anti-cyclical. It's having the guts to go against the herd. It means you're buying when everyone else is in a full-blown panic and selling everything. And it means you're getting cautious and maybe selling when the masses are partying in the streets totally euphoric. So let's step back. Why are we still talking about a guy who made his first trade 100 years ago? It's because his insights into human nature are, if anything, more relevant today than they've ever been. At the end of the day, his legacy really comes down to a few timeless ideas. 1, markets, companies, technologies, they all change. But human psychology, greed and fear, that never changes. 2, in this crazy 24/7 world of information overload, the person who can just stay calm has a massive edge. And 3, maybe the biggest lesson of all, money is not the end goal. It's just a tool, a means to an end, which for him was independence.
And that last point about money just being a tool, it's perfectly summed up in one of his favorite little anecdotes. It's a story about a poet, a banker, and a pineapple. So the story goes like this. A poet borrows 100 forints from a banker. And what does he do? He immediately goes out and spends it all on a fresh pineapple. The banker is furious, right? He scolds the poet for being so frivolous. And the poet's response is this question you see here. It's just a brilliant, brilliant challenge to this idea that we should just endlessly pile up money. It really makes you stop and ask yourself, what's the point of any of it if we don't actually use it to live?